If you look at the data, the labor market, at least on the surface, looks quite strong. But how much longer can this kind of jobs growth and this low unemployment be sustained?
Well, we've certainly seen the growth of payroll employment decelerate over the years as the economy has transitioned from the breakneck growth pace that prevailed coming out of the pandemic-induced recession to the kinds of more steady growth we're seeing now. So if you go back to 21, the average monthly job gain was about 600,000 per month. 22, it was about 400,000. This year, and we know this now as of this morning's data, 225,000 per month. That's a solid number. It's actually above the break-even number you'd need to keep unemployment low. And in fact, as you say, unemployment has been low. 3.7 in December, 3.6% on average for the year, both in 23 and 22. What's, I think, really interesting, I suspect we'll get into this, is the extent to which we've seen so much disinflation alongside that low unemployment rate. That isn't what a lot of economists were expecting if you go back a year or so.
I will return to the issue of inflation, Jared, but first I want to ask you about maybe one of the more troubling aspects of this report, which is labor force participation. Dropped to 62.5%, the lowest level since February of last year, and prime-age women also fell to the lowest level in 11 months. How much of that should be blamed on the fact that we have now gone over the so-called child care cliff?
I don't think the child care cliff is probably correctly associated with 1 month's result from these household data. They're very noisy data. We always try to smooth things out over a few months. It doesn't mean I would dismiss any of those numbers from the report. You already heard me cite the unemployment rate. It just means that we want to look over longer-term trends before we make any conclusions. When it comes to childcare, though, look, there is no question that this president believes that some critically important unfinished business is precisely in this area of making childcare more affordable. There's no doubt in my mind, in fact, there's solid research supporting this, that would support the labor supply of caretakers who are disproportionately women, of course. Over the course of the year, though, we've seen solid labor force participation, particularly from prime-age workers, and I think that's something that has helped us on the inflation side as well.
Okay, so let's talk about how the inflation and labor sides of the equation work together here, Jared. Is it more optimal for the U.S. economy, or more specifically for the American voter, for the labor market to stay this tight and strong, but that mean that interest rates stay higher for potentially a longer period of time, or for us to see a more material weakening in the labor market, but that comes with lower borrowing costs?
Well, I think the labor market is behind a very positive momentum that's prevailed now for quite a while. Basically, the combination of a persistently tight labor market, easing inflation, and of course that easement has been quantitatively quite large, has led to real wage gains. That is, wages have been beating prices for mid-wage workers, the 81% of the payroll workers that are production workers, blue collar or non-managers in services. Their pay has been beating inflation on a year-over-year basis for 9 months in a row. I can't say 10 because we don't have inflation for December yet, but we know their wages grew north of 4% in December, and I'm confident they'll beat inflation then. So that'll be 10 months in a row. That helps support consumer spending. We have a 70% consumer spending economy. It is a perpetual motion machine that has helped this economy move forward into the transition that you and I have discussed towards more steady, stable growth.
Well, let's talk a little bit more about, Jared, inflation, though, because you've raised it a few times, and this data comes amid a week where we have seen what many feel is an escalation, or at least ramped up tensions in the Middle East that have resulted in disruptions to trade from the Red Sea, now potentially adding to times higher freight rates, potentially higher energy prices. How much inflation risk do you see in what's happening in the Middle East, or more specifically the Red Sea right now?
Well, before I get to that, let's look a little bit at where inflation was and where it is. So look, let's in fact start with gas prices, which are very relevant to your question. Go back to mid-June of of 2022, and the gas price was north of $5 a gallon. When I woke up this morning, the national gas price was $3.09, so almost a $2 decline per gallon in the gas price. There are 30 states with the gas price below $3 right now. That is very much helping in terms of giving families some breathing room at the level of households, but also, of course, helping to support those macro dynamics I just reflected, with a strong labor market supporting consumer spending. Now, look, when it comes to the Red Sea, we're obviously working with a coalition to try to keep those supply chains open for commerce, and that's a different discussion with our security folks. From my perspective, thus far, the impact on energy prices has been quite mild. It's something that we're going to continue to watch very closely. But those energy numbers I just described to you, WTI, somewhere in the 73 range, I believe today, still don't see a ton of impact from that at this point, but obviously on our watch list.
Finally, Jared, I only have about 30 seconds for this answer. I apologize, but I know you at the White House like to tout gas prices. Why not play up the stock market a little bit more?
Yeah, it's a fair point. I mean, the fact is that most of the bottom half of the income scale doesn't really own stock, or doesn't own much at all. But for people in the upper half with portfolios, particularly with retirement earnings, it's definitely a positive trend. I think one of the things that we're very mindful of here is to not get too hung up in the bips and bops of daily stock market returns. So, that's important to us. We tend to focus on the paycheck and some of the more steady variables that you and I have talked about. But that's in the mix. It's one of the reasons why net wealth has been a solid performer for us in the last year or so.